If you come inside the Bloomberg here, you can see the 10-year yield and the net positions for the 10-year. We're still around record shorts. What happens with $73 billion worth of supply?
Yeah, well, I think we are set up for these auctions. I mean, it's not a big surprise that we have more supply. You know, we have more 3-year notes coming tomorrow. We have the 10-year and the 30-year later this week. But, you know, all of these things are being set up for in the market. So that's one reason why you have some of these shorts. I think the question is going forward, as these auction sizes get larger and larger, how good will demand hold up in that situation? So what you've seen recently is demand's remained about the same, but you have more supply. So your bid to cover ratios are starting to slowly come down a little bit. And if that continues for, say, the next 6 to 9 months, then there'll be a question is, can we hold these yield levels with this much supply?
Well, fair. So, Nick, how does that fit into your more less not bullish dollar thesis going forward in the medium term if we wind up having supply just not able to keep up?
Well, there certainly is an issue of absorption over time, but one of the things that we've also seen in the markets recently, and I don't know how long it's going to last, is this issue of twin deficits, a rising budget deficit, a rising current account deficit. So while these yields might move higher, it comes with some concerns or some risks, and so we don't necessarily think that the yields are going to be particularly supportive, and we would still continue to focus on relative monetary policy as being the main driver, and this as being a secondary consideration.
Well, Mark, what about that deficit from a different point of view? Because we talk about bid to cover ratios and what happens with the yield. But if you're a CEO, you're competing for capital. Yeah. And if the government's in there and is raising a lot of capital essentially by borrowing a lot of money, doesn't that make your life more difficult?
Yeah, certainly. If the interest rates, the large deficit and debt payments cultivate in higher interest rates, that would make cost of capital more expensive, and then obviously it would hurt the returns to corporations. The reason that U.S. companies have done so well for the last many years, they basically had a free cost of capital across the world, not just in the U.S., but in Japan and Europe and elsewhere.